Thank you for joining today's session. We will be getting started shortly. We do have a lot of folks signed up for today's session, and we want to give everyone a moment to log on and get connected so that we can dive into today's session. I do want to thank you all for joining us today. I am Jasmine Garrett here with the New Jersey Economic Development Authority. Today's session is an informational overview of the Net Operating Loss NOL program. A quick housekeeping note, we do suspect that many questions will be answered in today's presentation. However, you're able to write in questions at any point during the presentation using Zoom's Q&A feature. It is one of your Zoom command options and will allow us to make sure we are able to get back to you and let others see these questions and answers as well. Today's session is being recorded and will be posted on our NJEDA and YouTube pages. The slides and other resources will also be available in the next few days. Now, to get us started with the presentation, I will shift things over to NJEDA's Innovation Product Analyst, Faria Sheikh. Faria?
Thank you, Jasmine. Good afternoon, everyone, and thank you for attending today's webinar. My name is Faria Sheikh, and I'm running point on this year's Net Operating Loss program, along with Clark Smith. We will be going over an introduction of the program, along with an overview and recent updates. Then we will review the eligibility requirements in detail, along with the application process. As Jasmine mentioned, we will be wrapping up with questions. Please use the Q&A feature in the Zoom tab to submit any general questions about the program. If you would like to set up a call and review specific requirements, please reach out and we can schedule a follow-up call for a later time. To provide a quick overview, the NOL program allows eligible tech and biotech companies to turn the tax offset created by their losses into a tax credit, which can then be sold for cash to use for working capital expenses. An important point to note is that while NJEDA determines eligibility criteria for the program, the Division of Taxation determines and disperses the benefit amount. And here's a general timeline for the program. So the application went live last week and will be open through June 30th, which is the annual deadline. After June 30th, we cannot accept new information as part of the program, only clarifying information. So we encourage all interested applicants to apply early and reach out with any questions. After the June 30th deadline, there is an extensive review done within the EDA and with taxation over the summer, and we are targeting our September board meeting to go for approvals. Because this program has a declination process, we do give applicants an opportunity to withdraw their application as declinations become part of the public record. However, if declinations are issued, the applicants have an opportunity to appeal, and that could cause some delays in the final approvals being issued. After that, companies can go and sell their tax certificates to unrelated profitable corporations, and that process usually occurs between January to March. Then the sale deadline for the tax benefit is by April 15th, and then the program closes out for the year. So this program has a lifetime cap of $20 million per company, and that's the benefit amount. So not the portion of losses that they're selling. 20 million is the benefit amount per company. The program's yearly cap is $75 million, and we'll be going over how the funds are allocated in a later slide. There is a $1,000 application fee for the program, and there's also an approval fee for awards that are greater than $100,000, and it's 1% of the benefit amount, but no more than $20,000 total. In terms of eligibility, for sectors, we're looking for technology and biotechnology companies whose primary business involves the provision of a scientific process, product, or service. They must have protected proprietary intellectual property, defined as patent, copyright, or exclusive licenses, and these could be anywhere in the process. We'll be going over them later. Companies must also demonstrate at least 2 consecutive years of accrued operating losses in New Jersey, and they must not have been profitable. This requirement is demonstrated via independent CPA-prepared financial statements that are submitted as part of the application. Companies must have a headquarters or base of operations in New Jersey and have less than 224 total US employees. And this program is unique for employment requirements in New Jersey specifically, as we look at the minimum number of employees in the state rather than require a certain percentage. This is based on the company's earliest formation date. The company must also offer health insurance to its full-time employees. And important to note is companies must have a taxable corporate structure, as the benefit recipient is determined by that. So for instance, LLCs taxed as a C Corp could be eligible, but an LLC that is still taxed like a pass-through entity is not going to have any benefits to sell as the loss is passed through to its owners. So going a little bit further into the eligibility requirements, as mentioned, the company must have headquarters or base of operations in New Jersey. They must have owned, filed for, or have a valid license to use PPIP. And their primary business must be in either of these two sectors. And we'll be providing the presentation later to review in detail. In terms of the PPIP, it could be patents or patent applications that are assigned to the applicant. They could be exclusive license agreements, so the patent owner grant controls of all aspects to commercialize the technology. It could be a copyright, as with some software products, and applicants must demonstrate both that the PPIP is the applicant's primary business, that it is current, so it's not expired, and it enables the applicant to meet the tech or biotech business definition that was on the previous slide. And on the right are examples of some common elements that are not considered PPIP for the purposes of our program. Now, going into the financial statements, as mentioned, the company must not have positive net operating income in the 2 most recent years. For the application, they have to submit the past 2 years' financial statements or annual reports. We would not be accepting tax returns for the purposes of this application. The financial statements must be GAAP compliant and prepared by an independent CPA. The types of financial statements that we could accept could be reviewed, compiled, or audited, but they must contain all 3 statements. So the balance sheet, cash flow, and income statement with footnotes. For publicly held companies, the Form 10-K is acceptable, and we would be looking to collect financial statements from both the applicant and any entity that owns, controls, either directly or indirectly, 50% or more of the company. And a little bit more into the nuances, we could accept we can always accept consolidating financial statements and sometimes consolidated statements as well. Now going into the eligibility requirement for employees, as mentioned, the total US employees cannot exceed 224, including employees of all affiliates, parents, and subsidiaries. The minimum number of employees in New Jersey is determined by the company's earliest formation date. So if the company has been around for less than 3 years, they need at least 1 full-time employee in New Jersey at the time of application and at the time of sale. If the company has been around for between 3 to 5 years, they need at least 5 employees in New Jersey. And for more than 5 years, they need at least 10 employees in New Jersey. The employment amounts are considered from the company's earliest incorporation or formation date of the applicant or its earliest predecessor entity, irrespective of the corporate structure or tax status of the entity at the time of formation or incorporation. In terms of what a full-time employee is for this program, they must be employed by the biotech or tech business for at least 35 hours a week. Their wages must be subject to withholding tax in New Jersey, and therefore Pennsylvania residents, for instance, are not eligible for the program due to the tax laws. The employees must spend at least 80% of their time working in New Jersey, and they must be offered health benefits under a group plan. A full-time employee cannot be an independent contractor, consultant, intern, temporary employee, or be in a temporary position. And now I'll hand it over to Clark Smith for the remaining slides and questions.
Thanks, Faria. So again, my name is Clark Smith, and I'm the Senior Director of the Technology Innovations Department. And I'll be pitching in for the remainder of the NOL presentation today. So when it comes to the application, as Faria had noted, there is a $1,000 non-refundable application fee. If your application is approved, that $1,000 will be credited towards an approval fee if there is one, no more than $20,000 in total fees. Very important, your application should be complete and have all required documentation uploaded into it and then submitted via the system by June 30th. After June 30th, we can't take any new information. So if you forgot to upload some crucial part of required documentation, we would not be able to take it from you after June 30th. So that's why it's very helpful if you can submit it early and budget enough time. The other thing that I would add is the application transferred from the old legacy application system to our new portals-based application system this year. So while all the questions are still the same, the format is a little bit different. So it might take a little bit longer than it has in other years. Application is always accessible from the NOL's website, which is the njeda.com/NOL. We'll take you there. Also, njeda.gov/NOL will get you there. But if you have any more questions or on that side, the website is always the best reference. So to help with a word calculation, the benefit is not your actual accrued losses. It's what the tax offset to that would be. So to help with your estimation, it's going to be your loss amount times the top corporate tax rate in the state, which is 9%. And the estimated benefit you would have for that year would then be $450K. Now, these are not sold to a third party, so you would sell them at a discount. The floor is set at 80%, but it is subject to market rate. Typically, it's around 90% on the dollar. So an accrued net operating loss of around $5 million would work out to around $400,000 net to your company. Worth noting, in the application, you have to select the year, the type, and then put in an estimated amount. Please don't commingle all into one amount. And what do I mean by that? So if we follow the tax law, you can submit up to 20 years worth for sale. What you don't want to do is put all of your amount into 2025 NOL. You'd want to break it down by year and type. So if it's 5 years worth, you put each year, an estimated amount, and the NOL type. So each year, the program has $75 million to allocate. There's a waterfall allocation to determine how much everyone gets. So if we approve and have requested amounts that is larger than $75 million, everyone will get a portion of their benefit to sell. The first pool is for companies that are in either innovation zones, opportunity zones, or certified as woman minority owned. The way that that works is everyone in the pool will get $250,000, and then all of the companies remaining will get the $15 million allocated amongst themselves equally. If the pool of $15 million is exhausted, anyone that has not gotten their full approved amount moves into the general pool. If there are funds remaining in the pool, then those remaining funds go into the general pool. Then we do it all over again. Everyone that's approved gets $250,000, and then the remaining companies that haven't gotten their allocation filled will get a portion of their remaining approved benefit amounts. until the full $75 million has been exhausted. Now, the program does have recapture, and that's only under one situation. If within 5 years from closing your benefits, the company fails to maintain a headquarters or base of operations in New Jersey. The exception here is liquidation. If your company goes out of business, you're not subject to recapture. That said, if your company is acquired by another company, the recapture will still pertain to the new acquirer. The way that it works is within 5 years, each year, the recapture percentage will decrease. So if a company closes NOL benefits and within that same year, they leave the state, we can recapture 100% worth of that benefit to it equals 80% 3 years later, 60%, so on and so forth. Now, falling below eligibility requirements will not trigger recapture. So if you're required to have 10 employees and then 2 years later you only have 8 employees, you're just not eligible to participate in that year's program. Does not mean that you are subject to recapture. Again, NOL website is the best source for information on the program. There's the link to the application is right on that page, and it is a new application for 2025. There's also very helpful references there. So we have a document called the Program at a Glance that basically is a very quick document that you can use to establish high-level eligibility for companies. We also include in there a list of required documentation so you can prepare ahead of time and a very detailed FAQ. And that concludes the presentation for today. I'm not seeing any questions in the Q&A section. So I would say if you do have any questions after the fact, please feel free to shoot us an email at the address here or innovation.njeda.com. And all of those are linked on the website as well. Thank you for attending today.